Okay, and we are back for another live stream today, Wednesday, October 10th, 2018. I was not planning to do a live stream today, but we have some breaking news going on in the market, so I thought I'd give you all, my loyal listeners, an update. Okay, so today we had stocks and bonds both sell off, and we had a big spike in the VIX. The VIX is up over 40% in one day today. It's the largest VIX spike since much earlier this year in 2018. Almost everyone who pays attention to markets remembers the big VIX spike in February of 2018. We also had a aftershock in March, and since then we haven't had very much at all. So this is very interesting. But it's unusual for stocks and bonds to sell off together, and it looks like one of the major reasons why is what Jeff Gundlach, Mr. Bond King of Double Line Capital, has been saying, warning people that if the 10-year U.S. Treasury yield closes above 3.25% a number of days in a row, that will signal the bear market in bonds has begun and or accelerated. And so today, when we're doing this live stream, let me just pull up Yahoo Finance again really quick. We are at 3.225% on the 10-year bond. And the Dow is down around 3% below 26,000. It's time probably for the plunge protection team to come back in. Or one of the plunge protection teams. I mean, there's probably a bunch of them now. And then I talked about in the last Welcome to Dystopia with all the different rules changes, how now you have different governments trying to do different market interventions, changing the rules, etc. This is the new normal, and it freaking sucks. There are no free markets anymore. It's like what Chris Powell of GATA says. It's only manipulations. Although they may let some companies fail. Maybe it's a smaller corporation or something like that, or they're not politically connected. If you're a small business owner on Main Street and you're not publicly traded and you don't have the right political connections, you have free market capitalism. You have to protect your own ass. Yeah, so this is not going to be a super long show. Just wanted to give you guys a very quick update that we are having a sell-off in stocks and bonds. The VIX did spike, so this could be, because what we've had the pattern for a while now is we have a VIX spike for a short period of time, and then it gets hammered right back down. We'll have to see if this is going to continue, the pattern of the VIX staying higher and volatility coming back, or if it's just going to get hammered back down. We'll have to see. I get a lot of emails, Forza. I'm honestly not sure. I'm sure I replied. It said okay. I replied. I don't know your real name because you're not using your real name there, but just send me another email. Yeah, well, the plunge protection team's coming back in, or it's like what Victor Sperandio. See, Peter Schiff was on Twitter talking about how there's not going to be any buyers of treasury bonds. And I was thinking to myself, Peter, you need to listen to the Victor Sperandio interview or go read the article that Victor Sperandio wrote. Basically, the large U.S. banks change the rules now so they can, in this special accounts that they have, they can buy unlimited U.S. treasuries if they want, and they don't have to mark write down the assets, the treasuries, if they lose money. So they can use them and leverage those up as collateral. I tried reaching out to him on Twitter. I've interviewed Peter. Most people who are not familiar with my channel, I've interviewed Peter Schiff a couple times over the years. It's very hard to book him for an interview. He's not the nicest and fuzziest person. Let's just put it that way. And there was also a bad business deal with him in 2011. But I have interviewed him in the past, and it's not always the easiest thing to coordinate with him. But yeah, I think it doesn't fit his narrative, what Victor Sperandio told us about the rules changes with the Federal Reserve and the large U.S. banks getting the rules changes. The large U.S. banks are anyway guarantee that treasuries will be sold as part of the primary dealer arrangement. So there's always, but this was smaller amounts in the past. So the primary dealer, the incestuous primary dealer arrangement that the large U.S. banks have to buy treasuries, if they can't sell them, has always been there. Especially when the size of the U.S. Treasury market exploded after the last vestiges of a gold standard were disconnected in 1971. So, the large U.S. banks became primary dealers, and if they couldn't sell the treasuries, then they had to buy them at the treasury market. So there would always be buyers. But the Federal Reserve, and this was always a smaller amount, the Federal Reserve would buy them back normally under the table, create new money out of thin air and buy them back. A lot of people, this is kind of an unwritten rule that people on Wall Street have known about for decades. But this was always, billions of a few billion here, tens of billions there. This was never the amount of scale that we are at now. So in the last, let me pull up this zero hedge story so I get the numbers right. But okay, here we go. This is from September 13th. The U.S. government spent a record $433 billion in 1 month as the deficit exploded. So we're starting to get to enormous levels. In fiscal 2018, the U.S. spent a record $523 billion on debt on interest payments on the national debt. And that's not counting how quickly the national debt is growing, and also how now the Federal Reserve seems to be in rate hiking mode. They seem to not really care if they do invert the yield curve. At least that's what Lael Brainerd said in her speech recently. I covered that as well. And I was going to do a short video on this. Apparently, I don't know if the website's loading or if I have too many window tabs on my browser open here in Firefox, but the Federal Reserve's balance sheet is below 4.2 trillion. It is at 4.174704 trillion. So they've sold off over $300 billion in total assets, and I'm using air quotes because we don't know exactly what they've sold. We don't know exactly what they've bought because there's not real annual or even multiple times a year independent audits allowed of the Federal Reserve. So we don't know the exact number. We don't know their swap positions. All we know is what they sometimes disclose to us. There's a lot of libertarians and Austrian school people that actually still believe the stuff the Federal Reserve discloses to us. It's kind of ridiculous, considering what Ron Paul was able to get with the one-time partial audit. So, on the stated public balance sheet of the Federal Reserve got a size 4.5 trillion. We're now below 4.2 trillion. So that's not even 10% of total assets that have been sold off yet. But quantitative tightening is supposed to ramp up. It has ramped up to a certain extent. We're supposed to get to, now here in October, we're supposed to get to $50 billion per month in asset sales. And the other major news story I wanted to cover was, let's see here, let me get the date. So this was October 7th. It came out from the Global Times. China's central bank cuts reserve requirement ratios to unleash $109 billion. So normally when things are going good is not when central banks allow reserve requirements to be cut. So this signals that there is problems in China as well. And the dollar index was above 95. Let me just go back here. It was at 95 financial home. Let me just go back here on my Yahoo Finance real quick since we're on the live stream and everyone can hear me clicking. We are at 95.5. So I see, there's tons of people, permabulls in the gold and silver community and alternative media talking about the dollar. The dollar is topped. I see no evidence yet. I don't see any evidence that the dollar has topped. In fact, the dollar is still holding pretty strong at 95.5 on the dollar index. Maybe against a specific currency or two, the dollar is weakening, but against most of the G7, the developed world, Europe, and Japan, the dollar is still strong. Okay, guys, well, that's pretty much all the stuff I wanted to cover in this short little... Oh, there's one more story, and then I'll answer some listener Q&A in the chat. So there was, about 10 days ago, on September 30th, the story that Charles Schwab, the client cash hits all-time low as retail investors flood the market. So this is, people chasing higher highs, buy high and sell higher. Their neighbors are bragging to them how well they've done in their stock market index funds for a while now, and this is people going in with Charles Schwab, liquidating their cash and going into stocks, probably at the wrong time. Unless, the stock market does continue higher, maybe it does. There are people out there like Brent Johnson who thinks that the Dow will be over 30,000 by the end of next year and over 40,000 by the end of 2020. But we'll have to see. That would be like, a Ludwig von Mises style crack-up boom or asset price hyperinflation. But if the Federal Reserve is going to keep raising interest rates, and it seems they want to do one more rate hike before this year is over, and they want to do quite a few next year, they will eventually break something. Okay, there's precedent for this. With Alan Greenspan, after he created the technology bubble and the real estate bubble, trying to rate hikes before the 2008, hiking rates before the 2008 financial crisis, and that blew up subprime, the adjustable rate mortgages and the teaser rates and all that stuff, because everything was so leveraged. Things are even more leveraged now. Stanley Druckenmiller in his Real Vision TV interview said things are basically more than double the amount of credit and debt outstanding since the 2008 financial crisis. Hey, Dr. 8. Yes, it's a nice day to do a live stream. Just giving you guys a quick little update here. I don't know how much longer I'm going to be on this, but I will answer some listener questions. And I'm pretty much out of the stories. I wasn't planning on doing a live stream today, but since we have some breaking news, I figured I'd do something for you guys. Okay, so that's pretty much it for... Oh, also, I wanted to talk about that other stock, like online brokerage CEOs like TD Ameritrade and some of those guys. They've been talking about this for about a year, give or take, that a lot of their clients were not in a lot of cash, that cash balances were low. So the Charles Schwab is just piling onto that. But, you know, topping for stocks is like a process. So I don't know if we've topped immediately, but, you know, all these signals, whether it's the dollar rally or the Federal Reserve hiking rates or the Federal Reserve reducing its balance sheet, these things are going to eventually, the U.S.'s budget deficit's exploding, and I think there's signs of inflation. I think even a few of the Federal Reserve members recently have been actually talking about how inflation is above their 2% target now. Not all of them, but some of them, because there's hardcore Keynesians on the Fed who say that there really can't be any inflation with the Phillips curve. So we'll have to see, but I think there is evidence that there is more inflation, and eventually, you know, as all these things culminate and the market starts to understand these things more, there will be a breaking point, or something will break. It could be U.S. corporate bonds, because there's a ton of zombie corporations out there that need to. I talked about this on Welcome to Dystopia episode 44. There's, I think, $1.3 trillion in U.S. corporate bonds that need to be refinanced in the next 5 years. And those companies that need to refinance don't really have the cash flow or the assets to do it. So that's another accident waiting to happen. Maybe there's bailouts, maybe there's write-offs, maybe there's a debt jubilee. Who freaking knows at this point? Because guess what? The goalposts are going to be moved continuously, and the rules are going to be changed. We don't know what the rules are. The rules could be one thing for one set of people or one company, and something totally different for another set of people who are not politically connected in the right political party or a different company. Because I could tell you that based on the research and all the articles I've read and listening to other experts talk, Dick Fuld, the Lehman Brothers, was 100% confident that they would get a bailout up until the last couple hours. And even then, I still think he thought that Lehman Brothers would still get a bailout, or like some type of emergency merger. He thought the Federal Reserve would help them out, or the Treasury Department would. And it didn't. Okay, so I'm going to look at... I forgot my last point here because I don't have notes here, and I wasn't planning on doing a live stream, so I'm just going to look at listener Q&A right now. And take a swig of water. Buy 100-ounce silver. No, I don't really pay attention to UK stocks. I don't pay attention to UK stocks, sorry. You'd have to tell me. I don't pay much attention to small caps in the United Kingdom. There's a lot of problems there. Nolan Watson, when he did the Mariana Resources acquisition, he said he would never buy anything in England again. Another company. He said it was that bad. All the rules and regulatory agency. He wasn't even allowed to update his shareholders. That's how bad the regulatory stuff was in England. He said it was such a nightmare. He wasn't allowed to publicly talk about the acquisition for more than 6 months. It was that much of a pain in the ass. And the regulators there threatened him if he was more transparent. It was ridiculous. Big government, man. Rules and regulations. There's a lot of people out there that think that government and regulators will solve the problems. I can tell you they won't. Plus, there's a ton of fraud rules on the books here in the United States, and none of them get enforced, or they're selectively enforced. Okay, so plunge protection team, yeah, normal plunge protection team stuff. There could be that, well, we're after market close now, but someone could come in after market hours with futures and go and buy the futures. We've had this going on really since the 2008 crash, where a mysterious buyer, either right before market close or in after hours, would come in and buy $10 million or $20 million worth of S&P 500 E-mini futures. And if you talk to professional traders and hedge fund people, they'll tell you it just doesn't make a bunch of sense. But it happens all the time anyway. And normally it's to paint the tape, to prevent the support levels on certain key technical levels from breaking. It's happened for a long time. But apparently it hasn't worked as well in China and other places because, like I said, in past shows recently that a lot of other major stock markets and the other major economies are below their 50-day and 200-day moving averages. But the U.S. stock market seems to be different, and I've made the historical comparison to the last 2 years before the October 1929 crash, how tons and tons of money was indiscriminately flocking here to the United States. So from a historical standpoint, I'm still, unless something changes drastically, I'm still reminded of that. Plus, like Victor Sperandio said in his interview, the Federal Reserve was hiking rates then. The Federal Reserve made a lot of mistakes prior to the October 1929 crash. They don't take any of the blame from the history books. Milton Friedman does claim that they didn't put enough money in, they didn't do enough liquidity, but the Federal Reserve created a lot of problems way prior to 1929, October 1929. Murray Rothbard has good analysis of that. So if you're curious about learning more about that, Murray Rothbard has some free books and articles that are on the Mises Institute website. You can either get the audiobook or an ebook there for free, or you can buy the hardcover book or softcover book, or you can buy the audiobook there on Mises talking about that. His book's on the Great Depression and talking about how the Federal Reserve, created enormous credit bubbles in the 1920s, and it took the money supply away, and the U.S. was on the gold standard, and England was losing a lot of gold, and the Federal Reserve caved into pressure from the Bank of England, and the Federal Reserve should have, because more money and credit was expanding, more money was coming into the United States. The U.S. should have taken more gold and should have kept expanding the money supply according to the gold standard that was there, and the Fed didn't do that. And the Fed, in fact, stopped taking gold from England. The Fed started drastically contracting the money supply and raising rates. So the Fed basically intentionally crashed things. The Fed made a whole bunch of mistakes, though. I suggest reading the Murray Rothbard analysis of it. So there was a lot of mistakes years prior to 1929, but it was a disaster. And then, of course, capitalism and the free market was blamed for the Great Depression in 1929, when in reality it was like the credit booms and busts that the Federal Reserve had helped fuel years prior to the October 1929 crash. Same thing here. So the central banks and the large banks are causing these enormous credit bubbles and asset bubbles, and governments, want the banks to give out these loans because there's tax receipts. Look at the politicians in Vancouver. They've made hundreds of thousands of dollars extra in property taxes on some of these drastically overvalued properties. Same for Australia. 60 Minutes of Australia actually just released a series in the last couple weeks, I believe, talking about the housing bubble popping there. I was surprised to see that. So you are seeing cracks. I don't know when everything's going to totally crash, though, because the rules are going to change. There could be a debt jubilee, in a couple years from now. We just don't know. If Danielle DiMartino Booth, her contacts at the Federal Reserve, are mentioning that's crazy stuff. Okay, on to the listener questions. I went on a little rant there with some history stuff. Sorry. Yep, crazy day. Crazy day, Borza. Dean DeMola, we had dollar, bond, and global share market sell-off down today's one. Okay. Where did the capital go? Well, the dollar didn't sell off, Dean. The dollar index is at 95.50. So if anything, the money went into the dollar. Gold didn't crash. Gold's up slightly. So gold, a little bit of money went into gold probably because gold didn't crash too. Gold held up okay. It's kind of flat. And the dollar went up. Dollar's at 95.5. So the dollar didn't crash. So this treasury sell-off, money went from maybe bonds into cash, fiat currency. Or cash. Not actual real money, though. Not sound money, anyway. Okay, looking through more of your comments. The JASK 101. Where do you think the relationship is between rising rates and rising bond yields? Well, we don't have a free market in that. We don't. So we have a flattening yield curve. We have a lot of manipulation in the bond market. There's been plunge protection team. Can't remember if I showed charts on this. I don't think I did a short video on this where I actually showed screenshots. But basically, despite whatever monetary policy the Federal Reserve has done for a number of years now, that the 10-year U.S. Treasury yield has been in a pretty tight range. And so, there is, the Federal Reserve wanted a steepening curve, but they're not going to get that. And in fact, now it seems if they're going to keep hiking rates, they may be intentionally, or at least a couple of the people at the Federal Reserve may be intentionally, or don't care if they invert the yield curve. Maybe they want more ammo for the next crisis. Maybe they want to blame it on Trump when the stock market does crash, since President Trump has taken credit for the stock market being higher when candidate Trump called the stock market a big fat ugly bubble. So, and we know that a lot of the people at the Federal Reserve they're not politically neutral. A lot of them are very hardcore Democrats. I think even Ben Bernanke switched his political affiliations too. I believe he was initially Republican, and I think he switched after he left the Fed. And Janet Yellen was very hardcore Democrat. She was a bleeding heart liberal. And she was claiming some BS how, like, her monetary policy was helping the poor. Even though she was creating more inflation and asset price inflation and exacerbating and widening the wealth gap and making the rich richer with her monetary policy. Tomcat. No, it's too early. It's too early. This is just a crack. This is not like a Lehman Brothers or a Bear Stearns. Show me a big bank that's failed. Or if the regulators or central bankers or governments actually allow a bank to fail. I mean, look at what's being discussed and how banks in Western Europe were preemptively nationalized, and how regulators in Germany are talking about combining Deutsche Bank and Commerzbank. So, I mean, they know behind the scenes that things are much worse than they're admitting publicly. Until we actually see like a Lehman Brothers or an asset bubble or credit bubble fail, then, these are just cracks for now. Joe, they should have started raising it many years ago, this one badly. Well, they would have broken things. If they would have raised things years ago, they would have broken things. They know it. So they were lying for years about how the economy was improving. They were trying to speak it into existence. Okay? They knew the reality of the situation was much worse. And we're even seeing now the reality of the situation. The U.S. Homebuilders Index has crashed. Dave Kranzler, who a lot of people say is only good at picking out junior mining stocks, he nailed that. He's been calling for a collapse in the home builders for a while. The U.S. Homebuilders Index, take a look at a chart of that. It's on Twitter, also in the Wall Street for Main Street Facebook group. It's totally collapsed. So we're seeing evidence that the real economy is not doing well. Pad, this is funny. Today's pullback in the markets was to teach Trump to keep his mouth shut about the Fed. Well, that's funny, because if you go back and read some of the memoirs of some of these either Fed chairmen or people that worked in past White Houses, a lot of presidents, whether it was Lyndon Baines Johnson or Ronald Reagan or others, they've bullied Federal Reserve chairmen. So pretty much presidents from both main political parties, Republican or Democrat, they want to be able to spend money like crazy. They want interest rates manipulated lower. They want easy, cheap money and credit. So President Trump, it makes sense that, he doesn't want to pay too much to borrow, because he's running, like, as I've said this for over a year now. Actually, when he was candidate Trump, I was warning people about this, that he was planning on supply side economics, massive budget deficits, and that this would lead to much worse stagflation. So, we're gonna see it. There's evidence of this, that it's getting worse, and we're gonna see worse stagflation going forward, especially here in the U.S. Because everyone's not gotten really a lot of wage growth. And if you do get wage growth, that's, demand pull inflation, as the Keynesians would call it. So that would be inflationary too for some people. So for like Target and Walmart, you're seeing record, that type of retail, at least for the last couple quarters, you're seeing record demand there. So that's going to cause inflationary pressures there too. Yeah, crypto's in a bear market. We'll have to see. Tomcat, we'll have to see. So there's an enormous amount of chart damage. And I think a lot of people, a lot of the technical traders, that big momentum money, those guys who don't care about fundamentals, they only trade a chart that's bullish. Those guys are out. on the long side at least, and they're probably shorting. But there is institutional money on the long side. There's Mark Yusko, who just started a institutional level crypto index fund, and I believe it's 50,000 minimum buy-in for institutions, and he's planning on raising over $100 million in the near future for it. He may have already raised it. He's a hedge fund manager for regular stocks, but he also just started like a crypto, an index fund for institutions, 50,000 minimum. So he's gonna attract some money there, and that's gonna be more long-term money probably. I think he said he's looking at. I saw him do an interview on that in the last month or two. The JASK 101. Yes, shrinkflation in a lot of consumer products. I see that at a lot of the restaurants. When I ate my birthday dinner on Friday at the Japanese steakhouse, the shrimp appetizer that I used to get included in my meal used to get like 6 pieces of shrimp included in the price for the shrimp appetizer, 6 or 7. Now it's down at 2, and that's only in the last like maybe 3 years or so, 4 years that has changed. So they're reducing the other portions as well for the main course. So, and I've seen this at other restaurants as well. So I mean, this is pretty common now. There's also substitution of certain types of ingredients. I've heard not all restaurants, but some are doing that. So an ingredient or two that used to cost them more money, they're looking for ways to substitute that out, and they're trying that to try to either maintain or reduce their costs to maintain their margins, so their costs don't exponentially rise. Because it's all about margins. In business, if you don't have, only Tesla Motors gets away with this right now. But, things may change for that in that regard. But, in business in general, if you want a long-term business, you have to have good margins. You have to maintain or increase your margins. So only technology companies really get away with raising capital and not making a profit. Every other normal business in every other sector has to maintain or keep their margins, okay? So if you want to look at a business and you want to look at financial statements, one of the most important things to look at is margins. And go back and compare their margins. So you have your gross margins, you have your operating margins, and the net profit margins. And go back and compare the margins. And actually, that's how I found a shorting opportunity for some hedge fund managers in November. I noticed that MoneyGram, because I was researching like some of these money transfer companies like Western Union and stuff, and I looked at MoneyGram. This was when crypto was on fire, and I saw that MoneyGram, their margins were just like totally evaporated for their net profit margins, that they had gone from like 4 or 5% a few years ago down to like below 1% in only a couple years. And their revenue was basically flat. So basically every year, MoneyGram for a long time, it's like a no-growth business. That MoneyGram, MGI, has had like $1.5 billion a year in revenue. And their management team is very inefficient. So the management team can't figure out how to grow revenue, and they can't figure out how to cut costs. And so they've struggled maintaining net profit margins, which means that now the business, for a couple of years of not producing solid net profit margins, that business is essentially in liquidation mode. I would not be shocked. MoneyGram, I think, it had dropped from like $14 or $15 a share, I think November 2017, and now it's down to $5. And I would not be shocked if it's either in bankruptcy or near zero or selling out for pennies on the dollar after they liquidate whatever assets they can. The company's in liquidation mode. Obviously, stupid disclaimer, this is not financial advice, just my opinion. But I would not be shocked if the company's bankrupt a couple of years from now, or if Western Union buys the assets for pennies on the dollar, because they can't compete with Western Union. Western Union's more profitable and the market leader in that industry. And then also a lot of people at the margin are using altcoins and cryptocurrency, and they don't have to pay nearly the fees for MoneyGram. So MoneyGram is not only competing with a profitable company like Western Union, they're also competing against a bunch of cryptocurrencies that don't have to turn a profit, that are working their asses off. People are putting in hard work to lower costs there, like fees. So yes, if you want to start a business or you're analyzing a business, today's lesson, look at margins. Compare margins. And this is why the mining industry is not long-term a good business. It's about when you buy it in the cycle if you're going to buy mining stocks. The royalty and streaming companies are different. Their margins, their costs are controlled. Their margins are far superior. Because they don't have the overhead. They don't have the maintenance capex. Frank, the Dow is down about 3%. Let me pull up Yahoo Finance really quick. The NASDAQ is down about 4 right now, a little over 4%. The Russell 2000 is down a little under 3%, minus 2.86. Crude oil, I assume that's Brent, is, this one, Yahoo doesn't say if it's Brent or WTI. And gold is holding up all right. Gold's at $11.97. The S&P is down a little over 3%, minus 3.29. The Dow's at minus 3.15 as of right now. Well, actually, Jim, it's a bit more complicated than that, because all these major asset prices have been inflated for decades. So a lot of regular stocks have been drastically, the Dow to gold ratio and others, the stock market and a lot of real estate prices, the value of the assets has not really changed too much in real terms, and everyone's costs have gone up. So this has been a scheme for governments and central banks to increase tax revenues. Is they devalue currencies, and then the asset prices move up, and then they tax you more and more on capital gains. So this has been a long-term scheme, and it's been very successful for governments to keep borrowing and gaining more and crowding out private sector and gaining more ability to borrow and grow big government, because they need asset prices to keep going higher and not stay down for too long. And then that means they don't have to cut their government budgets. And then that means they can make, really dumb promises to either get elected or stay elected. And that's why we, even despite the asset prices where we are, we have long-term pension fund problems, because politicians, in spite of the asset prices being inflated for decades, we have politicians who have made ridiculous pension fund promises that cannot mathematically be delivered. Jim Mathers. Well, the German regulators have talked about Deutsche Bank merging with Commerzbank, and there was another article a couple years ago. I can't remember where it was. It might have been from Eric Sprott doing research on it, but Commerzbank was also leveraged 40 to 1 too. But Commerzbank in general is smaller. So Commerzbank has problems with its loan book and other, I think they have a lot of bad loans to like other parts of Europe and also maybe to emerging markets. But Deutsche Bank has that derivatives book that they bought from Bankers Trust, and that's where the major damage is. Because the derivatives liabilities for Deutsche Bank are in the tens of trillions. And Deutsche Bank doesn't have anywhere near that amount of money to pay it back. So if those derivatives, I'm sure that some of those derivatives have already failed, and there's been secret backdoor bailouts, because I've heard from my sources that that's what's happened. And that's why swap lines from the Federal Reserve to the European Central Bank have been open for years, since the during and since the 2008 financial crisis. Adam King, Japanese yen. Well, I think people could be closing up the yen carry trade. If they close up the yen carry trade, they have to liquidate their other trades, and they have to go to cash in yen. So they have to buy back their yen. So normally when it's risk on, I believe, for the yen carry trade, the yen gets devalued, the yen's not strong. The yen gets borrowed, and the yen gets exported and leveraged up outside of Japan and used to fund derivatives bets or other gambles in other either emerging markets or technology stocks or whatever. And so when it's risk off in Japan with the yen carry trade, I think that's when more of these investment banks and hedge funds close down their leveraged, super leveraged yen carry trade, and they go back to cash. And so that's going to strengthen the yen. So the yen's like a carry trade currency. The dollar is used similarly, although also because of the dollar's role as world reserve currency, the U.S. can just basically print, at this stage still, get away with it, print as much dollars as it wants and export them outside the country. And that's why the U.S. doesn't have hyperinflation in the real economy, in consumer prices, retail prices, workers' wages. Like I've said for a long time now, a lot of that monetary inflation with the increase of money and credit, there's an argument to be made that asset prices have been hyperinflated. Okay? So we don't have Dow 40,000 or anything like that, but the disparity, the divergence between asset prices and the real economy just continues to widen, especially in the U.S. there's a lot of different stock market valuation metrics, and they're all pointing to the U.S. stock market being overvalued. Now, that doesn't mean the U.S. stock market can't go higher. It just means there's no fundamental reasons, despite what you hear on Bloomberg, despite what you hear on CNBS about, them claiming all these fundamental reasons for why the stock market is going higher. There's not. So, and then that's why you get idiots on investing.com writing articles about how McDonald's is a growth stock. Yes, McDonald's has grown earnings per share. Okay, but beneath the surface, beneath those earnings growth, there's no revenue growth. There's no margin growth. In fact, there's the exact opposite for McDonald's. And Jim Chanos, who is almost never wrong. Now, normally Jim Chanos is early. So Jim Chanos has one of the best track records of anyone on Wall Street. If you're not familiar, he is rarely ever wrong on his shorts. But normally, though, he's early. So he may be a couple years early, but he's well aware of the problems with McDonald's. And McDonald's is financial engineering. So they're doing the board of directors, the CEO, the upper executives, they are getting rich. While McDonald's balance sheet, their debt in just the last couple of years, their debt on their balance sheet has increased over 100% to grow earnings per share, while their revenue is flat or dropping, their margins are not that good. So from an operational standpoint, if you learn fundamental analysis, when you look at the underlying business that McDonald's is running, it's getting worse, but their earnings per share is growing with artificially cheap debt and share buybacks. Yeah, I'm not that familiar with Snapchat, Chicago Electric. It's not really that good. It's not a profitable business. It's very popular among millennials, but it's not profitable. Instagram actually makes, I think, Facebook a lot of money from ads. People are addicted to those photos. Facebook did try to buy Snapchat too to gain market share, but I don't think on its own Snapchat's profitable. Twitter is not profitable. I think Twitter may have just made a GAAP profit recently, but I don't know if Twitter can consistently make free cash flow. Twitter is really useful, though. A lot of people really love Twitter. Although now Twitter's censoring, the amount of censoring is garbage. Did you guys see that Breitbart exclusive, how they got the leak, how Facebook now wants to be a good censor? They want to kind of copy what they've done for the Chinese government. So, beneath the surface, there's like a lot of freedom totally being destroyed right now. It's even getting worse. Like Facebook wants to implement even more Google wants to implement even more censorship in internal documents. I guess they got leaked to a journalist at Breitbart Technology that got released in the last 24 hours, give or take. And then there's a couple journalists. I think one of them was in Serbia, and she was exposing European Union corruption, and she ended up, she was probably killed. And then all the crazy stuff that's happening to Julian Assange. No, Frank, I don't think... I haven't seen any more evidence yet that we're ready to collapse. We have to see more. There has to be some more... This is just a crack, okay? Because what has happened for years now is maybe the VIX will spike once in a while, and then it just gets hammered right back down. There's a problem here, a problem there. The rules get changed, money gets printed, money gets moved by one government or another, a fire gets put out. So, plus with these currency swaps right now, I mean, it's a lot easier, since the rules have changed since 2008, it's a lot easier to put out a lot of these fires with the currency swaps. If they took away the currency swaps, everything would have collapsed since pretty shortly after 2008. And there was a lot of free market people, Austrian school economists and bears that were calling for a very quick collapse not too long after 2008 and the reflation and the QE programs. And the reason that it didn't happen is, number one, a lot of people don't want to collapse. So a lot of regular people who don't see the world the way we do, they want to buy in, that the stock market's going to go higher, that the people in power are going to solve something. There's tons of people still giving Ben Bernanke and Hank Paulson and Timothy Geithner credit for saving us. I still hear it all the time. And they're like, and I'm thinking to myself, how are you a genius? How are you smart if all you did was just change the rules, don't throw anyone in jail for committing fraud, and you just do bailouts. Exactly, Jim. It will all work until it doesn't. And then when something else breaks that's too big for them to fix, they'll probably, as I said in the last Welcome to Dystopia episode, just change the rules again. Yeah, Frank, they've been dumping more backdoor covert quantitative easing to paper it over for years. The U.S. has been covertly bailing out Europe, European Central Bank, and European banks for years, since 2008. Well, Tomcat, Amazon is a very sophisticated fraud. Amazon, on a lot of the items they sell, Tomcat, does not make any money. Okay, they actually break even or lose money on a lot of the items they sell. And let's see here. And so basically the fraud is like a revenue only generation. They have to grow and they can't allow the stock price to fall too much. So the Amazon plunge protection team will be at work in the near future. Oh, before I go, because I've been on here too long, there is 2 really good interviews from Tesla Motors. I added Dmitry Kofinas, who hosted one of the most popular financial cable shows, Capital Count, years ago. I added his new podcast and YouTube channel, Hidden Forces, to the featured section on Wall Street for Main Street. I did the same thing for Christopher Irons at Quote the Raven, because I think both of them are doing good work. And in the last couple weeks, Dmitry Kofinas has interviewed 2 experts on Tesla. The guy who was Montana Skeptic, he came out and he got doxxed, but he came out under his real name. And he did an interview recently. And then there was a really good interview with Gordon Johnson that I think if you guys want to learn more about Tesla Motors and how big of a fraud it is, watch that Gordon Johnson interview. So things are going to be unraveling for Tesla very, very quickly, probably, in the next couple months. They really need to raise capital very soon, and Elon does not want to pay the interest on the debt for the convertible bonds. He wants those guys to switch over to equity, take equity instead. So it'll be really interesting to see what type of new scheme Tesla comes up with. Okay, well, that's it for today's show, because like I said, nothing was planned. I didn't put notes down. I just want to give you guys a little update. And with China lowering, and on this note, with China lowering reserve requirements, I think that's the signal that things in China are not doing well either. So pretty much and I've been saying this for years, that the global economy, there was all these people saying the global economy was doing good, Jason. You don't know what you're talking about. And I was like, well, those are the government numbers. The government numbers were saying that the global economy was doing well. But beneath the surface, a lot of the other data was saying the global economy was not doing well. And so now you're finally seeing a lot of people admitting, with this dollar rally, with problems with emerging market corporations and emerging market banks and emerging market governments overborrowing in dollars, you're finally starting to see the things over the last couple of years that I was warning people about. And that's because everything's been done with debt. Okay? It wasn't always this way. Decades ago, it was not like this, but things have evolved, have morphed, you could say devolved. But, the global economy basically has turned into a global credit Ponzi. So China doesn't want to, they don't want to fix their economy. They don't want to allow a market correction or clearing event, because that would cause social unrest. So they'll probably be doing bailouts and stuff like that. And lowering reserve requirements means that they don't want the banks to go insolvent. Well, the banks are already insolvent there. They're going to probably bail out the banks in the near future anyway. But lowering the reserve requirements gives the banks some more leeway. They're trying to get the banks to issue even more credit. And there's enormous amounts of non-performing loans in China. So the U.S., there's a lot of problems in China. There's a lot of problems in the U.S. And Europe is maybe something that the U.S. and China will both have to figure out some type of solution for. Because China sells a lot. There's like a lot of people in China who want China to focus on Europe. Well, if Europe collapses and the U.S. has been secretly bailing out Europe, then maybe the U.S. and China are going to have to figure out a solution to bail out Europe then. And this is the new normal, where there's rules changes and bailouts and they hide things from us. I think there's always been stuff that's been hidden from us, but never on this scale. We're on like Theater of the Absurd, Twilight Zone, Bizarro World type of scale now. Chicago Electric, and yes, with Amazon too, like some of my orders for Amazon, they've screwed up. The last out of the last 5 orders from Amazon in the last like handful of months, I've had like three or four of them screwed up, like really, really bad. But they do have a lot more cash flow coming in from Amazon Prime. So that should allow them to, they're not in any danger of bankruptcy or anything like that. And even if they were, I don't think Bezos would go to prison for fraud. I don't even think Elon Musk will go to prison for fraud. And if you listen to those interviews, there's people saying that Elon Musk is committing even worse fraud than the woman at Theranos, Elizabeth Holmes. There's people like laying out the case that Elon Musk is a worse fraudster than the lady who started Theranos. Okay, guys, well, that's it for the show.